Hi everyone and welcome to this week's episode of Kickstart Your Real Estate Investing. In this week's episode, I'll cover part 2 of the adjustable rate mortgage product, and in this particular episode, I'll talk about when is the right time to use an ARM and under what circumstances you should not be using an ARM product. Okay, so just as a refresher to ARM, so what it is, just like the name suggests, an adjustable rate mortgage is one where there is a fixed component of a duration of time of the loan where the interest rate is fixed. And then there is a variable part of the loan where the interest rate fluctuates based on the market index. So based on how the market is doing, the interest rate can go up or down. Okay, so there is a fixed component, and the fixed component normally the banks will give you out a teaser rate. So what is the teaser rate? That is a rate where it's going to be lower than what you might do on a fixed rate loan. So if the fixed rate loan right now is going at, let's say, 7%, you might get an ARM product which is going at 4% during the teaser period, right? So you might get a fixed rate for a period of, let's say, 3 years or 5 years, which will basically be a 4% interest rate. But after that period of time completes, your interest rate can go up because the market index might at that point of time may be a very high interest rate market, and now suddenly instead of paying a 4% interest rate, you're paying a 7% interest rate. Okay, so that's the characteristics of the loan. So based on that, you have to decide when is a good opportunity or use case for you to leverage an ARM product. Okay, so before we get into that, let's talk about when you should not be leveraging an ARM product. So let's assume you're doing a buy and hold strategy and you want to basically buy an asset and hold it for the next 20-30 years. Now in that case, what you want is a consistency in the way your interest payments are paid out. So even though your interest rate might be a little higher right now, you should still go for something which is consistent because your time duration is 20 to 30 years. In that duration, the interest rates can come down, you can refinance it. But it's very important for you to have a very consistent payment which is going out, so it's more predictable for you. Okay, so in those circumstances, you should not go for an ARM, because what it does is, let's say you go for a 3-year ARM. For 3 years, you might get a 4% interest rate, but for the remaining 27 years of the loan, you might have an interest rate going between 7 to 9%, even higher, depending on what the caps are. So you have to be very careful that when you're trying to look at a particular investment span, the duration of how long you want to hold on to the asset, that should also determine what kind of loan you go for. Okay, so you have to be very careful about that. The second scenario where you should not go for an ARM is, let's assume you're buying a particular asset and you're saying that I want to buy this asset and I'm going to hold it for long term, but the interest rate is low right now, so it's allowing me to buy this asset because the numbers work for me and I'm cash flowing, right? But if you don't do the full analysis of saying, okay, what happens after the interest rate, the low interest rate period is over? What happens in those circumstances if the interest rate goes up? Does my numbers still work? And if you have not done that analysis, and if you are going directly to buying that particular ARM product just because the teaser rate is lower, you might have a lot of trouble in the future because you might get into a negative cash flow situation. So you have to be very careful about those scenarios too, and that scenario should not be doing an ARM. Okay. So now we spoke about the scenarios when you should not be doing an ARM loan. What are the scenarios where you should do? So a good scenario for you to do that is, let's assume you're trying to buy a loan, you're going to fix it and they're going to flip it. Okay, so you might want to hold a loan for a duration, let's say 2 years or 3 years. You're stabilizing the asset, you're increasing the rent, and now you're going and turning around and selling it. Okay, so in those circumstances, it might make sense for you to take a 5-year ARM. Because your investment horizon is so small, you're basically going to hold the asset for the next 3 to 4 years. You're okay for a 5-year ARM where you get a lower interest rate, which allows you to have more money you can spend on basically stabilizing the asset, fixing it up, getting new tenants in, that you're better off getting a lower interest rate now because you have no intention of holding that product for 20-30 years. Okay, so in those circumstances, ARM loan is a very good way of getting into it. Second scenario where you might want to do an ARM loan is where you're basically saying that, okay, I'm going to buy a brand new asset. I'm not going to fix it or anything, but my horizon is 5 years. My horizon is 7 years. I don't want to go and invest beyond that. After that, I'm going to sell it and buy another house which is like that, right? That's a strategy which I use. So I basically go in and buy brand new single family homes. I try to get ARM loan because my investment horizon is 5 years. After 5 years or maybe 6 years, I will go and sell that particular home because it's still new. I'll still get a good appreciation on that, and I don't have to worry about holding the asset for 20, 30 years. So in those scenarios where you know your investment horizon is also small, that is a good opportunity for you to leverage ARM. But keep one thing in mind, ARM loans carry risk. So if you are risk averse and you do not want the volatility of all the interest rate changes on a yearly basis, you should stay away from ARM. Okay, many investors have got into a lot of trouble by trying to get into an ARM product and then hoping the interest rate will go down. And when it does not, they end up in a lot of problems in the way that their assets don't cash flow. They have to put some more money in just to keep the asset going. So be very careful about when you're leveraging it. But at a general guideline level, how long you plan to keep the asset will really determine whether you go for ARM or not. And what is the intent of it? Are you doing a fix and flip? Are you going to a long-term hold? That will also determine whether you want the funds now by paying a lower interest rate, or whether you want to be on the safer side and want a longer amortization schedule where you're paying a fixed rate of interest for that. Okay, so folks, that's what ARM loans are all about. So please be careful how you use it. It's a double-edged sword. It can be very useful in certain scenarios, but it can also be very hurtful. So be very careful when you're evaluating ARM. Definitely have a look at it, run your numbers. It is a product out there which many banks offer. So do ask your bank whether they do ARM loans for investment properties. And if they do, at least run the numbers, at least understand what it looks like, and then look at how long you plan to hold the asset and whether an ARM loan is going to be helpful to you, because it does carry risk further down the line. Okay. Hope this episode was helpful to you. If you liked it, please go ahead and like and subscribe to my channel, and I'll see you next week. Thank you. Bye.